Good afternoon, ladies and gentlemen. It's May 22nd, Thursday. I am back from vacation. You're watching the Stock Market Brief Show. This is where we navigate the financial markets through the lens of technical and intermarket analysis. On today's episode, I want to talk about where the S&P 500 could potentially go to from here. I want to talk about some setups that are taking into place in the market currently. And then I also want to look at some of the intermarket correlations, just in case if we start to see yields back off or if they continue to press forward, same with the dollar. So be ready to see some updates on that, some signal charts, the expected moves in market conditions. Let's get into today's show. All right, ladies and gentlemen, welcome back to the show. Yes, it feels good to be back from vacation. I always love a little nice trip. S&P 500 is still disconnected from this weekly 5 EMA. Remember, this is one that's frequently tagged, and when we get very extended from it, like we showed in the last video, it's likely to see some sort of a rubber band retracement, some sort of a snapback consolidation, etc. So we're pulling back a little bit here. It's down 1.95%, but honestly, from this low to this high, it literally is nothing. And I'm out there on the X space, Twitter previously space, and I see a bunch of people, singing Kumbaya about catching this short. And really, the public service announcement here is if you're celebrating that 1.95% move so far to the downside, it really lets me know that you probably missed the bulk of this rally. And that's why I say shorting is a much more difficult task. And it's typically easier if you don't want to try to catch the ups and downs. Now we start to look for where the market can pull back to and find some strength, because that would probably be an easier trade, at least in the current context that we are in. Now, the 10-year yield has been on a nice little rampant run over here, but price action is getting fairly tight. You see the price momentum oscillator down here above zero and trending higher. So there's a pretty bullish move here in yields. However, today I'm not big on these candlestick patterns or so forth, but let's just talk about the psychology of them. This right here is a dark cloud coverage candle, which where you gap above the prior day. It looks really good. It's breaking out and then all of a sudden reverses, closes more than 50% in the prior candle. And those are typically reversal type candles, but they need to obviously be confirmed. So what I'm pointing out here is price action's getting tight. We had a little bit of a reversal candle. So hey, if the 10-year yield wants to dive in a little bit here, we got to look at what's correlated positively and negatively to the yield. And before we even do that, oil, right, typically leads the 10-year yield. And you can see that here. You can see that oil is the black line, and then the candlestick chart is the 10-year yield, and they move hand in hand, right? We saw oil find a bottom over here back in September of the prior year. Shortly thereafter, 10-year yield found its low there as well. You can see they peaked out around the same exact time over here, and we've seen pops and drops, and sometimes we get eventually some correlations that break where the 10-year yield went higher, but oil continued lower. And why I'm pointing this out now is because, as you see here, the 10-year yield has been reaching higher, but yet oil has been actually kind of fading from this point. So is oil once again leading the direction of what's going to potentially happen in the 10-year yield? Now, I don't know if that's going to be certain or for sure, but when we take a look at the absolute value of this, when we see the dark cloud coverage over here, when we see that oil has been going down, hey, that makes sense to me to see the 10-year yield potentially consolidate or back off from this move that we've currently seen. Is that guaranteed? No, but it's just an idea and a thought, and that's what's leading me to say, hey, let's look at some of the correlations here in the market if the 10-year yields were to actually back off. Now, first and foremost, what's negatively correlated to yields? Well, bonds, right? So if the yields were to back off, well, you could potentially see bonds, right? It didn't have a dark cloud coverage. It had what's known as a piercing pattern, closed at the highs, started at the lows right on a gap down, but closed on positive for the day, also known as a red to green day. We also came down into this prior area over here that acted as a level of some sort of support. Now, this is adjusted for dividends. I have to do unadjusted to get more pure price action, but bear with me there. It's fine. You're also getting that very tight price action here, and you're coming into these prior levels. So if the 10-year yield were to back off or yields were to back off, what's the correlations in the market right now? Well, surprisingly enough, the S&P 500, now I'm looking at 20-day correlations, okay? So this is not just like a one-day thing, right? I'm looking at 20-day correlations, where they stand. It's like medium term. And what am I seeing here? The 10-year yield, this is the 10-year yield chart. It's been going up, and this is it correlated to the S&P 500, the NASDAQ, small caps, IWM. We got Bitcoin over here. We got the housing market. And then I even put in China, which is KWEB down here. And what do you notice? These are very, very strong positive correlations. What does that actually mean to you? That means that if the 10-year yield were to actually back off from this point, there's a higher probability based off of this correlation that the markets go down actually with it. As you can see, S&P 500 is very positively correlated. Even the NASDAQ 100 is at a 0.90 correlation coefficient. So this right here is a very strong shorter term, medium term correlation to the 10-year yield. So the thought here simply is, hey, if this 10-year yield backs off, it's not a guarantee that these products go down with it, but right now they are pretty strongly positively correlated. Now, if you look at the sectors, so this is 10-year yield up here, but now I'm looking at sectors like technology, right? That has that strong correlation, no surprise there. Consumer discretionary over here, then communications also strong. And which ones don't really have much of a correlation at all? That's consumer staples. So consumer staples, right? No correlation, meaning that it doesn't really matter. XLV, healthcare, has a negative correlation. So what does this mean? It means, well, actually, if the 10-year yield were to back off, does that mean that we actually might see a positive move in healthcare names, which we just recently saw a nice bounce, and since then it's kind of faded in. They've been doing pretty bad all year, but that could be one to watch there as well. And then you have the XLU, which is more risk off. This one doesn't have a strong positive correlation comparatively to the other names, so that could be a potential rotation candidate as well. There's another intermarket asset that a lot of people would say that have been doing this for a while, saying if you know where the dollar is going to go, right, you may know where a lot of other assets are going to go. And well, here's the dollar, and this is where it gets a little confusing, right? The dollar right now is positively correlated to the S&P 500, NASDAQ, IWM, and those are also fairly strong correlations. Not as strong as the 10-year yield, which is why I showed that first, but this is still one to watch, meaning what? That means if the dollar goes higher, that actually can potentially benefit the S&P 500. Now, if the dollar goes down, right, that can negatively impact the S&P 500, the NASDAQ, IWM, and so forth. So that means right now in this current situation that we're in, a falling yield and a falling dollar doesn't look like it'd be great for the markets. But what happens if the dollar potentially bounces from here and the 10-year yield comes off? Well, maybe that just means that we stabilize more and we potentially just consolidate, okay? So those are what's kind of currently going on. You look at how it's correlated to just various sectors. Once again, healthcare seems to stand out over here in a negative correlated state to both the yield and the dollar. Yeah, yields and the dollar. So I guess a falling dollar and a falling yields could very well help healthcare in this, I guess, current context, in this current correlation. So that's what I'm looking at here. Basically, if you're picking up what I'm putting down, if the yields were to fall, I think that that's a good opportunity for maybe a shorter term play in bonds because maybe they've sold off a little bit. Now they might potentially have the ability to bounce. And then also, if that is the case, maybe some healthcare names too. But I don't necessarily want to stop there because there are some really good looking names in the tech space that I don't think we should just walk and breeze over. Because if the S&P 500 and the NASDAQ were to come down, I think it's going to be very critical to know where it can come down to. As far as today's performance goes, we did have consumer discretionary and technology leading the way. Rather flat trading day overall if you just take a look across the board, Dow, S&P 500. And this is all occurring at the time when we were talking about how signal charts were getting a little frothy, how a lot of people are on one side of the boat. So this is the technology sector bullish percent index. I've been sharing this one with you. It looked frothy. Looks like we're going to get a pullback. There will come a time where we're back down here looking for the buy to dip opportunity. It ain't right now and right here, but technology is just taking a little bit of a breather. That's it. That's all it's doing right now. I will look at the put to call ratio and say that, hey, when this crosses back up through 8, this is kind of one of those signals that I'm looking at. I'm saying, hey, everyone's once again partying on one side of the boat here. If you were partying on one side of the boat here during this consolidation, this breakout, well, guess what? It got faded pretty hard. And the same thing actually goes back into 2021 when we started moving into the bear market of 2022. Now, I'm not calling for this same outcome, but what I am saying is, hey, if you're bullish here, guess what? You're part of the crowd. You're part of consensus because that's how positioning is. So sentiment is bullish. They're partying on one side of the boat. And that doesn't mean that they can't be wrong or they can't be right. It just might take some time or we might go through a consolidation sooner. All right. Now, if you also look at just the options equity put to call ratio. The prior one is the total. This one kind of shot up here, and we talked about how it was down at 0.5. And, when we got to 0.5 on this 5-day moving average, it started cranking up higher from there, and that put pressure on the markets. And then over here, too, it was down at this kind of area where we say, it's a little bit frothy. And what did price do? Well, we went sideways for months, and then we actually started going higher here and selling off. And now that we're back down in this area, I'm just pointing out that if we start heading higher here, right, sentiment shifts, we go through a period of consolidation, a pullback, whatever it may be. So I hope that I prepared you all enough from the prior video and the video prior to that, that we're coming into an area where we're going to consolidate. I don't think that there was any surprise there, and I just wanted to provide data to really support that. But it's important to also note that even if we get a pullback, we got to understand where it can go to, because the market just saw a massive rally. And I think that if people start saying, well, the low's not in, we're going to go take this low out down here, cool, you might be right, but that's not something that you can really just position for right now, because you could, but where's the risk? Where's the reward? How long are you planning on holding that type of a trade? And what happens, right? If we pull down, you're like, oh, woohoo, and you just hold it, but then it rips right back up and goes like this. Right? What's your plan then? So you need to always practice if-then scenarios. This right here is MAGS, right? The MAG 7 stocks. This is just an ETF for it. And I could have shown you all these individual names, like Amazon looks really good. It's nice and flaggy. I mean, NVIDIA, all of them basically are just consolidating in. I'm showing you this one. It's an ETF of the big MAG 7. But I mean, does this look bearish to you? I mean, this is a breakout move that was just a monster move, and now it's consolidating. So if it were to slip off more, does that mean anything? I mean, that would be another higher low potentially? That's what we got to pay attention to and watch for. And that's why I'm saying I'm not really bearish. I'm just kind of waiting for price action to consolidate more or pull back and add to strength if it makes sense to. Now, where can the market pull back? And that's why I wanted to layer out some of these VWAPs, because these VWAPs can be just really, really important tools to know shifts and changes in market psychology, because you know where the average buyer basically is. Now, this is the all-time high anchored volume weighted average price. That's the green. We got through that. And what did psychology do? Well, first off, it rejected it here, got rejected, boom, came back up here, rejected, and then we finally broke through. So what does that tell you from a all-time high perspective? It tells you that from the all-time highs, right, everyone was kind of in the red based off of the time and the volume. And then when we started getting above it, guess what? Things got a lot more bullish. People got more excited. The average buyer based off of over there is now positive. So anybody that's been buying is now positive. It's a big psychology shift there. And price action, what? Consolidated into this white line, which happens to be the year-to-date VWAP. Guess what? Boom. And then we saw an explosive move from there. And what did that tell you? Well, now, from a year-to-date perspective, everyone is basically in the green based off of that time and that volume. That's what these VWAPs do. So why am I sharing this with you right now? Because there is some confluence with some of these levels that I want to revisit that happens to be just right in this area between 5,600 and 5,700. You can see that we have still the all-time high VWAP. Price can act at once resistance, can have the potential to act as a level of support. Then we have this level down here, which is really our, officially kind of first lower high, right? You might be able to call this one, so second, third, whatever you want to say, how small your little lower highs. But this was a pretty significant pullback that scared people, that basically, I think everyone was caught flat-footed when this rally really kicked off over here. If you were watching this channel, you were prepared, hopefully. And we saw this monster rally. So I'm anchoring a volume weighted average price to this higher low. That seems to be important because that's when this lockout rally kind of occurred. And then you see that right here. Then we have the year-to-date VWAP also. So all this little confluence in here, I feel like could be an area that if price were to pull back here, that's about a 6% drawdown from this peak to down here. And that to me is like nothing in this market. So I would be looking to be a buyer back through and around any of this zone over here if we can start to see strength. What you can do as well is you can anchor a volume weighted average price from this recent high and see if price just doodles around and these start to congregate, move closer together and start to pinch. This is what Brian Chan calls the VWAP pinch. It's all this is doing is showing what we always talk about. One of the basic principles of the technical analysis is stocks and markets. They move between contraction, boom, expansion to contraction, and then back to expansion again. So those are some of the key aspects that I'm looking at As it stands right now, we're in positive gamma territory. So dealers look to buy the dip, seller it. Volatility typically comes in, but we're basically, let's call it gamma neutral because we're right on that gamma flip line. And if we cross under it, it does open the door for dealers to become sellers into selling, buyers into buying, where volatility typically increases. So there may be a potential shakeout here based off of some of these signal charts, based off of what we talked from some intermarket principles. And if that's the case, I just don't want you to be freaked out because a 5% drawdown, 6% pullback, I mean, that would actually be healthy in this market. So that's what I want to prepare people for. But by prepare, I don't necessarily mean, hey, let's short this market. That's not what I'm doing. You do what you want to do. I could care less about shorting the market, at least going net short in my portfolio, typically a long-sided trader. And, people can attest to that because I'm in the United States Investing Championship. And then on top of that, that's basically the only trade ideas I share in my Patreon group. If we take a look at the direction of the 5-day moving averages right now, what's it saying? It's saying basically watch out across the board for SPYs, Qs, IWM, because they are declining from the shorter term. So typically in these situations, like we've said in prior videos, if you want the market to prove itself first, you would then wait for price action to confirm that versus saying, hey, the market's selling off. I think it's wrong. I'm going to buy now, right? And then you're trying to prove the market that you're correct versus letting the market prove to you that it's on your side. So right now, yeah, we're seeing some consolidations and some declining 5-day moving averages from a much shorter term. In the very near term here too, we have tagged that lower weekly expected move. In fact, I do got some kind of interesting data here. We've had now 21 trading weeks, including this week over here. That's 21 trading weeks. There's only been 3 weeks that actually we did not tag the implied move. I think it was that week, this week, and there it is right here on that week. So 3 weeks we did not tag out of 21. So it's very common. What this tells me, it's very common. Once we get these weekly expected moves, there's a high probability that we're going to be tagging those expected moves, and it gives you a good idea for risk. There's been 9 weeks out of the 23 that actually closed outside of it. Last week, we actually opened outside of it on some news, and we went for a 2 standard deviation move. This is what you call a gamma squeeze into its entirety here, where the market gets it so wrong from a risk perspective that you have all this dynamic hedging kick in, and it just squeezes pricing higher. Just buying begets more buying, begets more buying. So massive move there. Now we're taking a little breather where to the lower implied move. We're not really far out of it this week. Now, from a month-to-date perspective, we got outside of the month-to-date, and we were saying on some live streams, it's saying it's very common to see price come back in, and that's what we did. We're right there at the month-to-date expected move, and the month's almost over. Quarter-to-date expected move, we tagged actually down here, and then that ended up being a good buying opportunity. Typically, in the first month, if you get it this quickly down to the quarter-date move, that's going to scare a lot of people out. That's for sure. We've seen this, in the past happen very, very suddenly, very quickly. And both cases that we've seen it recently, within the last 2 years, it's happened, I think, twice now. It's been ending up being good buying opportunities, and you can see it kind of resolved itself higher as it stands right now. And then, like I said, yeah, so 3 did not tag it, 9 closes outside, which is telling me that the market's a little unstable here, and that makes sense given the context of all the uncertainty that's been going on. But overall, it's been a very good indication of what the market's perceiving as risk. And this week, it said $9.22. That's plus or minus in the SPY. Now, if we take a look here at the exact levels for that, you have 603.42 to the upside, 584 to the downside. You see the month to date and last year's closing price. I knew that this price would act as some sort of support and or resistance. You can see it's support, support, support. We broke above and now it's acting as resistance. So this last year's closing price seems to be pretty important as well. Tomorrow's daily implied moves, these ranges, we're looking at about 578 to 575 beneath us. So if we get some selling, that might scare quite a bit of people, but this would be within market's expectations for the day, but that would be breaking outside of that lower weekly implied move. The higher probability is typically to come back in and doodle around. Remember, tomorrow is the last day of the week, and we're going into a holiday week, so it's going to be an extended weekend, which means we're going to have less trading week for the following week. So to see people start to go on vacation early, I mean, we still have surprisingly about a $4.06 expected move here, I believe it is. Let me pull that up. Yeah, for $4.92. So that's a pretty large expected move going into tomorrow, given the context that it's going to be an extended day. So give this the room for it to move, right? And these are some of the key zones to watch for. Just understand we're still below a declining 5-day and that week to date. So if we start coming up here, this would be the levels of resistance to watch out for. And this would potentially make a lot of sense to just do not much tomorrow. So we'll really see what this market wants to bring. Now, I want to kind of hop into some of the names, right? We talked about how healthcare, right? If the 10-year yield were to back off, maybe we see these rotations into healthcare. So I just pulled up a shot here of the top 20 holdings. You got Eli Lilly, J&G, ABBV, UNH, SRG, ABT. Now, I didn't go through all these. I went through like the top 4, right? You can go through more if you want to see names that are kind of firming up or setting up. But one of them, right, UNH has been getting a lot of attention because UNH had this massive, massive sell-off in a short period of time. It was down like 64+% or something like that. And we just recently saw a nice bounce that everyone timed perfectly, apparently. And, we rallied up higher. And this is the daily chart. This is the 30-minute chart. And I'm sharing this because, hey, if we start to get a bid back into healthcare, perhaps we see this bounce again. And we saw a nice bounce here. And now we're seeing kind of our first pullback on some declining volume over here. The VWAP that I posted here was from this low, and you can see it's currently holding right now. So, if we start to doodle around in here and break from this prior little swing high, that can open the door for a nice pop back up to 320, 325, 330 perhaps. But if it gets below this, I'd want to wait and just see how the market kind of proves itself before, getting overly excited. We have an inclining 5-day moving average, but it's saying caution, meaning that price is below it, but it is still inclining. So coming back up here and potentially breaking out, that could be a pretty positive sign for a gap fill, like I said, for the near term, shorter term. If what we're talking about plays out, which is the correlation holds to be negative and yield kind of backs off there, could be more of a positive catalyst for something like this. ABBV seemed a little interesting here too. Also, not a great looking chart, but price action is kind of firming up within this down channel. So if we maybe start to break out through here, yeah, I've seen some pockets of some decent volume over here on the up days. So if we can kind of get through this 185, maybe this does produce a pop up to 190 to 200 range over here. That's another, not a little, it's one of the top holdings, but that's another healthcare type name. TMDX. Now, this one's just doing good after earnings and it's been consolidating. I know this isn't a healthcare space, but I'm not too familiar with it and its market cap and so forth. So you got to do your own research, but I'm just pointing this out because this one's at highs of the year. It's consolidating here tightly, which is nice, offering up good risk to reward. Perhaps if we break out, you have a stop and you pop up to 135, 140, 150, and we get some continuation there. So that could be another name. BCRX. These aren't really my favorite type of names. This is like a biotech type of name, but we had earnings, the market liked it. Now it's been consolidating that in this kind of pennant formation. So perhaps we do break out and retest this prior high of 1111 and maybe even go through that and go try to test 12, which this is a high beta name. Once again, these aren't my favorite type of names, but I figured I'd share that for people that might like this stuff. Then beyond healthcare, right, there's a lot of other names, right? We talked about some of the Mag 7 stocks, the Mags, even, Amazon was in the trade ideas today. Here's CEG, Constellation Energy. This is a utility name, right? Nice consolidation. There's a lot of names that are consolidating tightly. So this one, right, after a strong move up, we're consolidating. Is this going to break out, have a good stop? Are we going to go try to retest this at about 320? That'd be a crazy, good trade right there with low risk versus, good upside potential. So there's another name that I'm kind of just eyeballing. Oklo, right? These names are these high beta story type names as well, but it's consolidating here, right? This isn't in the healthcare space. This isn't like nuclear energy or something like that, right? Oklo consolidating here after a pretty big move. Now, right, if you're in the Discord and you're watching this is one of them that I posted from a while ago after this bullish kind of high volume print candle over here. It seemed as if we can potentially start consolidating and moving higher. That was back in April 7th. You can see kind of the trade set up there from April 7th. And we got there, right? We got to this green line. Now we're trading right up here, consolidating again. Another one is NNE. This one's not doing as good as Oklo, but it is consolidating here too as well. So if you like these kind of higher beta story type names that had the potential to pop, I mean, you have, as long as you're managing your risk within what we're seeing here, if it breaks out, it offers up some pretty good risk to reward. And then obviously a lot of the names that are kind of hitting everyone's radar right now are quantum computing, like QBTS, BT, I believe, is RGTI. There's a bunch of different nuclear quantum type names. And, this thing was massively up today. And once again, I don't get excited and try to trade these names from a swing trading perspective when everyone is talking about them, which that is the case. But if you look back over to here, back on April 7th, this is kind of where I'm looking at these names, right? So QBTS was over here. We saw a nice reversal candle. It seemed as if we can hold this area. It could be a potential play. It was right over here. And well, that is going from what, set $6 and now it's at trading at $19. So, pick your entries wisely and just manage risk. I didn't know it was going to go up to here by any means, but it made sense from a risk to reward standpoint that if we start breaking through this year-to-date VWAP, right, and it can hold this prior area, it makes a good sense from a risk to reward standpoint. Another name like CrowdStrike, just a good consolidation near these highs, but you have earnings around the corner. You see pockets of just really good volume over here as price action has been kind of just trying to just doodle higher at around that 460 pivot. So once again, look at, I'm saying that like, hey, we might see a rotation in healthcare. That doesn't mean I'm like bullish long-term healthcare because the charts, most of them look like they suck. But a lot of these tech stocks that we've just pointed out look really good, right? CrowdStrike consolidating here, offering up good risk to rewards. The mags are, but it is also, I want to be very aware that the market is still seemingly on one side of the boat here, very bullish. So perhaps if we get a little bit stronger of a shakeout to some of those key VWAPs that we're paying attention to, that could be that shakeout move potentially that leads us to another rally. And I think we just got to be on guard for that. Not, if it doesn't come, it doesn't come. Whatever, that's great, right? Then our longs keep longing, right? But if it does come down to that, I don't want people to be freaked out necessarily. I want people to start looking for strength after. So I hope that makes sense. That's all I got for you on today's episode. Hope it helps out. See you later.